Why keeping your money in the bank is secretly bleeding your wealth. 1. Idle cash is financial deadweight. Over £526 billion in the UK and over $8,000 per person in the US. Sits inert in low-interest savings accounts, generating negligible returns. This isn't prudence, it's passive wealth erosion. Inflation silently chews through the real value of idle funds. A sum like £10,000, while numerically constant, buys less each year due to inflation, effectively losing purchasing power even as it appears stable. With average investment returns around 8%, the opportunity cost of not investing compounds dramatically. For instance, £10,000 invested at 8% annually becomes over £21,000 in 10 years. Left in cash? Still £10,000, only now it buys you far less and makes your hard work look like it clocked out early. Footnote. Leaving your money in a low-interest bank account guarantees one thing: you'll get poorer safely. 2. Emergency funds, not emergency fortresses. The purpose of an emergency fund is not to hoard cash indefinitely. It's to maintain financial continuity in the face of income disruption. Calculating the correct amount requires isolating essential monthly expenses, e.g., rent, groceries, basic bills, minimum debt payments, and multiplying by 3, 6, or 9 depending on employment stability. Anything beyond that threshold is simply unassigned capital, better suited for earning returns elsewhere. Financial institutions love your fear-hoarded cash, but inflation loves it more. High-yield savings accounts, currently offering 4%, serve as better homes for this category of money: liquid, accessible, and not quietly shrinking. Footnote. A bloated emergency fund is just anxious investing in disguise, and it's losing value every day. 3. Big balances trigger big spending. Cash left unsegregated in a single account distorts perception. The brain registers a large number, not its allocation. Money saved for emergencies, major purchases, or long-term goals gets mentally reclassified as spending money. This cognitive bias fuels impulse decisions. The solution is automation: route income through systems that allocate funds into investments, savings, and bills immediately. Keep your spending account lean. Out of sight, out of temptation. When financial hygiene breaks down, so does discipline. Systems prevent sabotage. Footnote. Cash in one big pot fools your brain into thinking you're richer than you are, until you aren't. 4. Insurance has limits, and so should you. Deposit insurance isn't infinite. In the UK, FSCS coverage caps at £85,000, in the US, FDIC insurance ends at $250,000 per person per institution. Balances exceeding these thresholds are uninsured and vulnerable in the, admittedly rare, event of institutional failure. For near-term goals, within 5 years, cash may be appropriate, but it must be diversified across accounts to remain protected. For goals beyond 5 years, market investment significantly outweighs short-term risk with long-term growth potential. Volatility in the short term is noise. In the long term, it's wealth. Footnote. Bank insurance has a ceiling, and your money might be dangling above it, unprotected. 5. Big balances make big targets. Large visible wealth makes one a prime target for sophisticated scams. Phishing, social engineering, and deepfake frauds have evolved far beyond Nigerian princes. A notable example: a high-net-worth individual was duped into sending $1.2 million to a fake WhatsApp group chat populated by AI-cloned voices, deepfakes, and fabricated influencers. The scam was elaborate, social-proofed, and nearly indistinguishable from legitimate interaction. Even savvy individuals are vulnerable. Spreading funds across investments and limiting liquidity in core accounts minimizes exposure. Footnote. If your balance makes you look like a prize pig, don't be shocked when the wolves show up. 6. The case for smart diversification. The corrective action isn't panicking, it's reallocating. First, calculate a lean emergency fund based on need, not anxiety. Park it in a high yield, easy access savings account. Second, outline short term, under 5 years, savings goals and use term deposits or high interest savings for these. Third, move excess funds into diversified investments such as index funds or robo-advisors via tax-advantaged accounts. Set up automation so that investments occur before you ever see the cash. The less time money spends exposed to your whims, the more likely it will grow. Footnote: automated investing turns your paycheck into a wealth engine, not a temptation trap.